Hello and welcome to episode 1 of Budget Decoded by HDFC Securities. My name is Preksha and I'll be hosting a special series on the Union Budget 25-26 under the NDA 3.0 government. A budget that has come around at the time when consumption is weak and growth has slowed down. Joining me today for episode 1 pre-budget to decode these challenges and share his expert take is none other than Mr. Devarsh Vakil, Head of Prime Research at HDFC Securities. By the end of this episode, you would have the key macro views on how the budget is expected to impact our economy. Mr. Vakil, thank you so much for joining us. It's a pleasure to have you here.
Yeah, pleasure is all mine, Preksha. Thank you for
Thank you,
having
sir.
me.
So, sir, let's start with the big picture India's growth story. We see that the growth has slowed down. Do you think this slowdown is cyclical or are there any deeper issues at play?
So let's start with the global growth and then drill down to India. As now everything is connected, we are living in a global village. So global economic growth represent a mix of optimism and caution this year. US, the largest economy, is strong. There, the fiscal stimulus is running through the system. Technological innovations and inflation has came down there. So US is likely to grow. Overall GDP growth is projected to be around 2.7%. Some regions demonstrating resilience, while others are going to be challenging. India actually slowed down to 5.4% growth in the September quarter. But we think that is a one-off offbeat quarter. There were a string of climate challenges that hurt the agricultural production, and there were high-stake elections. So government's focus was there. So expenditure slowed down. But I think we are again seeing signs of growth coming back. The slowdown should reverse from here. When we look at the economic indicators for the month of October, November, December, January, we see that the manufacturing PMI has come back. It has increased. The services PMI also showing signs of growth. The high frequency matrices like GST, e-way bill, toll revenues, all are showing signs of revival. So I think India appears to be a structural growth trajectory. We have multiple positive factors. The long-term earning potential is there. The policy environment is favorable, and we think that the fixed income side we are going to see a lot of flows. So India is poised to deliver a strong growth going ahead, and it remains the one of the fastest growing economy in the world.
Great, sir. So we aim to be the ambitious $30 trillion economy by 2047. What reforms or measures do you feel are critical for accelerating that journey?
Let's break down this $30 trillion target by 2047, which has been put out by the government. So first, let's take India's GDP for FY26. It is about $4.3 trillion. About 360 lakh crore is expected to be GDP at on FI right now at FY26. We are at exchange rate of 86.5. Now, if we grow by 11% and if we keep inflation around 4%, uh, that means about 7% real GDP growth, then we can reach about 4,000 lakh crore. Now, historically, rupee keep depreciating about 3 to 4% every year. So it may reach by, say, 200 rupees a dollar by 2047. So that if that happens, India would not reach the target of $30 trillion. We will be around $18 trillion. So there are two aspects to achieving that target. First is the growth, and second is the depreciation of rupee. If rupee depreciate by 2.5% per annum, and if we manage to get about 11% growth, then we think that we should be able to reach $30 trillion mark. So we need policies that can continue the growth momentum as well as keep the rupee depreciation in check. If we are able to do that, then we are likely to achieve that target of going to $30 trillion by 2047. If rupee keep depreciating, then I think we may the direction is clear. The timing may vary. Instead of 2047, we may reach it by 2055. And if rupee depreciation is kept under check, there is all the chances that we may achieve that target even earlier also. So let's see how government forms policies in this budget, and depending upon that, we can take a call whether India will be able to achieve that target or not.
So, sir, this time, what do you believe? Would the budget be tilted towards the populist measures or will there be structural reforms?
So a populist budget usually provides an immediate relief to the public, basically a short-term boost to markets and sentiment in order to get uh, these popular budgets are frequently designed to get with one eye on political gains, focusing on securing higher voter turnouts. But given the past trend, and this is the second budget of this government, I think that the fiscal prudence will win over the populism, and we will have budget which will focus on structural reforms. Now, we know that in order to keep growing, we need a lot of structural reforms. Key areas of structural reform is infrastructure. Massive investment is needed in transportation, power, even logistics side. Digital infrastructure requires a lot of investment, and we need these investments to improve the efficiency. Second big reform which is required is on the land acquisition side. There is a need to streamline the land acquisition process where we want to ensure fair compensation to the landowner as well as enable the faster transfer of land for the infrastructure development. So I'm expecting that these kind of reforms on the infrastructure side should come in this budget. On the financial side, we need deeper corporate bond markets to provide the alternative financing channels for our finance sectors, where we require a lot of new regulations. Financial fintech is a sector where we need a lot of encouragement for creating the financial ecosystem for greater financial inclusion. On the labor side, we require a lot of reforms for skill development and also creating a human workforce pool which is aligned with the industry's needs. So I think these kind of measures on education side, on debt market, and on infrastructure are expected from this budget.
Great, great, sir. So the inflation is still above the RBI's 4% target. However, even though it has eased, there are some inflationary pressures that are denting the consumption and growth. So, what sustainable measures can we expect in this budget to bring inflation closer to RBI's target of 4%?
There are two sides to the inflation equation. One is the supply side and the demand side. So demand has been weak, as we all know. So government has to take steps to boost consumption. The reforms are required on the supply side. Agricultural infrastructure investment is required to bring the food inflation down. If the government announces scheme which encourages better storage and better distribution of food, then the agricultural supply chains can be modernized, and that will help bring the food inflation lower. We think that the government may increase allocation towards irrigation, and that will reduce the dependency on monsoon, which will help the supply side uh, equation. On the demand side, I think fiscal deficit will be kept under the check, and that will keep the inflation and the interest rate lower, and that will help the industry start with the capital expenditure, and that will boost the productivity. Uh, Possible some custom duty adjustment and some domestic supply related issues on essential commodities are also expected. We need a lot of support for our MSME sector. So I think in order to promote investment by MSME, we can expect some kind of boost in this budget. So if government is able to come out with these measures, then I think we'll be able to increase the efficiency of supply, and that will help us tame the inflation in this country.
Got it, sir. Sir, and do you think the government will prioritize growth and consumption, or will we see tighter fiscal deficit control?
In fact, the government is likely to achieve a lower fiscal deficit this time as a percentage of GDP. I think they have budgeted about 4.9% in the budget. But in FY25, it is likely that they will be able to achieve a deficit of 4.65%. And this is likely to be driven by higher than budgeted gross tax collections and combined with the lower than budgeted the capital expenditure. it is clearly evident that the FY25, in order to keeping the fiscal deficit in the check, the capex has taken a huge beating. The election led slower capex, and then the government was also trying to shift focus from bringing the debt down, and that is resulting into a lower fiscal deficit target. This tight fiscal positioning and rate easing cycle are likely to keep the bond yields also under check. And I think these are the multiple levers by which government is likely to keep the average 10-year yield by around 6.5%. So I think government will focus on prioritizing the tighter control over fiscal deficit, and eventually they'll be able to keep the interest rates low, which will in turn help the capital expenditure cycle and eventually boost the growth.
Got it, sir. And so, considering the fact that forex reserves are under pressure and rupee is facing headwinds, do you think investors should prepare for more volatility ahead?
A very pertinent question. The ongoing depreciation of Indian rupee is a major problem, major concern for Indian investors, for foreign investors, and it is leading to a lot of volatility in Indian markets. The INR also, our currency also faces competitive devaluation risk from other emerging markets. And if US under the Donald Trump administration put a stiff tariffs on China, that may trigger a Chinese yuan devaluation, and that can start a currency war. So there is a risk of further depreciation of India's currency, which may hurt our trade balance, and that will in turn put a pressure on our exports. So we need to keep our current account deficit under control, otherwise it will shoot up. The strength of the dollar is expected because the US under the new Trump administration is taking a lot of pro-growth policies. So there is a near-term risk for Indian rupee and other emerging market currencies. We need to take decisive policy measures to attract manufacturing into this country. We have to boost our exports and also take measures to balance the trade balance, correct the trade balance of our country. We believe that the global supply chain realignment under the Donald Trump may impact exports going forward, and it is important that the government takes necessary measures in this budget so that the current account deficit can be controlled around 1.5% to 1.6% of GDP. And if that is ensured, the rupee will be stable, and with likely reduced forex intervention going ahead because of the less headroom ahead, we think that if we are managed to keep rupee around 87, 88, that should be suffice to keep the growth momentum going. So forex and currencies are going to be a very important variable to be monitored going ahead, especially in this financial year.
Yes, sir, true. So the capital markets have had a mixed year. So small caps have seen corrections while large caps have held their ground. Investors are now looking to the budget for cues on whether it could trigger a rally or at least provide some stability. So what's your outlook for the markets post budget?
So obviously it depends upon what kind of budget is there, but smaller stocks, as you mentioned, have experienced a broad-based correction. They have created attractive valuation in some market segments. Several sectors like consumer durables, banks, select chemical and pharmaceutical stocks uh, have undergone substantial correction, and these sectors offer compelling value proposition at current levels. Looking ahead for the year, I think we still favor the stock selection rather than uh, expecting significant returns from benchmark indices. The current consensus forecast for Nifty for the Nifty aggregate earning is approximately 1050 for FY25 and around 1200 for FY26. That means index is still trading 19 times FY26 earnings. The third quarter of FY25 earning is expected to show a modest growth of 3%. And we already saw about only 4% growth in the first half. So the trajectory of the growth remains a concern, and the anticipated mid-teen earning growth for second half of FY25 and FY26 is looking a little challenging. So the earnings slowdown is primarily concern for the markets. Sector-wise, industrial, infrastructure, pharmaceutical, IT, real estate, these are the sectors which are likely to deliver strong earning growth, and that these are the areas, pockets where investors should uh, try to look for opportunities. But as I mentioned, calendar year 25, we continue to favor large cap stocks and only select mid cap and small cap stocks because the risk reward is in favor of large cap stocks. We anticipate that the resurgence in the domestic cyclical sectors in the second half will help financials and industrial sector real estate. And these are the areas where we should look for opportunities.
Mr. Vakil, thank you so much for that, and thank you so much for joining us today and sharing your valuable insights. The viewers have definitely learned a lot from this. With that, I call it a wrap on this episode. Stay tuned for our next one, where we'll analyze the sectors that could thrive or struggle post budget, uncovering opportunities and challenges for the investors. Until then, thank you for listening, and as always, happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.